And let's talk about the third spectrum then, which is regarding social. The biggest topic of the last couple of years is the migrant crisis. A lot of people migrating from Syria and a few other countries. And is this a real crisis, or is it more of a media sensationalizing the actual issue?
No, it's not being sensationalized at all. It's a real issue. And, it will be the issue for the French election when it comes out. Same thing for the Germans. Even Austria, they're having another re-election coming up. Now, it is in the fall. I don't know what the exact date. But it's there. And, regardless, even if it was sensationalized or not, these anti-establishment parties, they're all running on anti-migrant and anti-Euro, anti-EU platforms. And, those guys are coming up with a lot of reasons on why on this other vote for them.
Let's move on to the last spectrum now, which I think is the most juiciest, which is the financial spectrum. You've seen with interest rates, the last 30 years, they've just continued to decrease. What are the implications of this going forward? And then we'll move on to the negative yield in bank loans, which you've already discussed, but there are a couple of charts that I wanted to include there. So what are your impressions on interest rates?
Well, overnight rates by central banks are going to stay low. Here in Canada, we expect the Bank of Canada will be at zero very soon. Their next move is down. It's literally not going to go up. And I would be, not surprised at all with, once they either go negative or they do QE first, one or the other. But that's where we're headed with overnight rates in Canada. But let's talk about, the ECB is very clear what they're doing. What people don't understand with the Fed is that they really want to raise rates. And it's not because of inflation, employment is getting better. Those data points is providing support for them to do it. They really do understand that they absolutely crushed the saver in the U.S. market. That the investor we talked about earlier, who was getting a little bit of interest on their bank account and term deposits, they ruined the financial lives for a lot of those people. And at the same time, it's having an enormous effect on banks' balance sheets, and same for insurance companies as well. And then at the same time, a lot of American government pension plans that are put together, they're mandated to be invested in treasuries. And so they're not earning any income. So when you hear about, the Fed, they want to raise rates, whereas a couple of years back, they had low rates to help stimulate their economy, they want to get them back up now because they know they've created this other nightmare, the non-income nightmare. And, U.S. banks, they look, pretty healthy right now compared to a lot of other banks in the world. But if you chat with any bank analyst today, anywhere in the world, the first thing we all look at is what's happening with net interest margins. And the amount of free income that banks are earning is going down and down further.
And that's what you call net interest margins?
Yes, yeah, okay. Or NIMs, NIM.
Oh, I was saying the negative interest rate margins have been coming down for several years then.
Not for several years. It's really over the last 6 months with negative rates. So the slide that I talked about earlier that showed the amount of negative yielding bonds in the world, I think maybe today we're up closer to 13 trillion, 14 trillion in that range. Remember, when you have overnight rates, they're already at zero or negative.
Right.
It's the long end of the yield curve that's coming down.
Okay.
And that's how you're getting more and more government bonds trading with a negative yield on it. And as the long end comes down, so the difference between overnight rates, the central bank rate, and say the 10-year on a bond, that's what's compressing. And that's what's reducing the net interest margin for banks.
Interesting.
We're in for, so when the sovereign bond market, when it eventually breaks, in equity markets, banks are going to be a horrible place to be invested. And Canadians especially don't get that yet. Most of the market, if they see it, they're not allowed to talk about it.
Mm-hmm.
But
well, as long as the
where's the crisis back in 2008, 2009? Like, it hit the top half of the bank's balance sheet. It was the loan portfolio that got hurt.
Mm-hmm.
When the sovereign debt market breaks, it's the regulatory capital that gets hit.
Mm-hmm.
The bottom 10, 12%. And so the amount of leverage that is supporting, it's significant. It won't be one bank being hit, because they all hold the same sovereign debt. So every Canadian bank is holding, Canadian federal government bonds.
Mm-hmm. Mm-hmm.
American banks hold treasuries and so forth.
Good. Talk about the term deposits. You mentioned about investors not really getting a rate of return on their savings anymore, as the U.S. government wants to increase the rates as soon as they can. In one of your outlooks, you mentioned certain periods in the 1980s, 1990s, 2000s, and 2010s. And just an overall conclusion, what has happened to those term deposits back then? What are some of the variables, and compared to now? And just a few conclusions.
Well, the crisis that we're into today, it's on a global systemic basis, and a lot of the problems that term deposit investors may have had back in the 80s, 90s, and so forth, they were bank-specific problems.
Yeah.
So, everyone knows the Northern Rock story over in Britain.
Mm-hmm.
Lined up. That was the first bank to go under.
Yeah. And just to interrupt real quickly, sorry. In the 1980s, just to give some background to the listeners, in the 1980s, an average term deposit, and this is coming from your chart, from your global market outlook, was 15%. And then in the 1990s, it went down to 7.5%. 2000, 3.5%. And 2008, 2015, 0.5%. And now we're at negative.
Yeah, so that's the Fed overnight rate, what we're looking at.
Right.
Yeah. So, a few years ago, Carney was here I'm in Halifax, by the way, and Carney was here for luncheon.
Oh, okay.
So, back then...
And Carney's the bank, was the former Bank of Canada head.
Yeah, absolutely, Mark Carney. So he's at Bank of England now, and prior to that, he was head of the he was the governor of the Bank of Canada.
Correct, that's right.
So this is probably 2011 or 12, and I'm listening to him speak, and we're a global macro firm. That's what we are. That's what we talk about. And back then, there are not a lot of us around. I think in Canada, less than 5 maybe.
Mm-hmm.
Today there's a lot more, because everyone knows that's the story. That's what's driving markets today. And I'm very critical of what central bank policy is, because it's, in our view, it's not the right policy. It's actually, it's the problem. It's not a symptom of the problem. And but what Carney said back then is, we're socializing the bad debt problem. And so what that means is that when the crisis hit in 2008 and 2009, instead of making those investors who should have had a loss take the loss, which would have been bank bondholders, term deposits, and equity holders, they said we'll rescue the banks, and those losses are still there, but we're going to spread them across all of society. So we're going to socialize this problem. What that meant was the way you spread the problem out is by cutting interest rates down to zero effectively. So instead of having, I should say, a $10 billion loss, at Bank ABC, or $100 billion, or let's use a better number. Instead, $100 billion has been wiped out in income that would have been paid out across the country.
Mm-hmm.
See what I mean? See the difference?
Right.
And so that's having a huge impact today socially. That a lot of people who wanted to retire, they couldn't. There's working at the Tim Hortons and Starbucks and stuff like that. It's a lot of the youth, they can't get jobs, for what they trained for in school, and student debt is going up. It's just such a nightmare out there right now because of what central banks have done with interest rate policy. And, the last thing I'll leave everyone with is that what we're experiencing in the world today, it hasn't happened in our lifetime, not in your grandparents' lifetime, and it won't happen again going forward. We really are living in this pivotal moment.
Mm-hmm.
And it is going to, I know it sounds dramatic because it is, but once things start to turn around, and they will, they'll get a little bit, when I say like things will get worse, with the way financial markets work, the bond market's going to be horrible, but U.S. dollar equity markets will just be incredible. That's the way people have to understand this. You can be bearish but bullish on the stock market.
Mm-hmm.
That's what we're headed towards. That will confuse a lot of people as well. But once we get through this, it's going to be an incredible period we're walking out through.
Mm-hmm.
But for any investor out there, just to bring things full circle, you really have to do what the very wealthy people around the world do, is that run away from losses, protect your capital, and it's not as easy to do that today because of where we are in the cycle.
Mm-hmm.
But if you're able to do that, coming out on the other side, it's going to be a lot of fun. A lot of fun out there.
Mm-hmm. And I guess let's have a last couple points here on that spectrum, and then we can go into what you think is best and how to navigate these markets and make money, and relate that to also the precious metals sector as well. But can you talk about these last 2 points where 0% yield, what does that mean to the individual investor, to whoever has a bank account in whatever country? What does that actually mean? And then if you just can talk about, there's some countries who have actually put forward a bail-in policy for banks. So if you just talk about those 2 points.
Yeah, so what zero rates, what they do is studying that anyone with money in a bank, you're going to get zero interest. And that's effectively what it is. And so putting the whole picture together, we already talk about net interest margins are being squeezed everywhere.
Mm-hmm.
You might have noticed your bank now is they're increasing their fees for everything. A few dollars here, a few dollars there, it's just enough to be annoying, but, they're trying to make, as much money as they can because, they're getting squeezed everywhere else.
Mm-hmm.
The whole bail-in policy that's, it's flapping around out there, that they did it to the Greeks and no one seemed to care too much.
Mm-hmm.
Now that it looks like it will have to be applied in Italy, all of a sudden everyone is stepping back and saying, whoa, we weren't expecting it to happen in Italy.
Mm-hmm.
So the reason that's a very big cause of concern is that a lot of retail investors hold Italian bank bonds and have their money on deposit at Italian banks. So the social loss is just incredible. It immediately wipes out the Italian government if that happens.
Right. Well, I mean, the bail-in is already in the Canadian banks, from what I understand.
Well, all the banks have agreed to it. When the IMF and when the Troika may come out and they say, this is our policy, it's already been approved by the Americans. Where do you put your money? Again, the U.S. dollar is going to really surprise people how strong it gets.
Mm-hmm.
We're likely to get some softness in it into the fall. A lot of that will be driven by the U.S. election coming up, especially if Trump surprises and wins. But thereafter, it's like if the Canadian dollar appreciates over the next few months, which we expect it will, we think it will. That is your opportunity then to you want to sell Canadian dollars and buy USD. Anyone living in sterling and euro land or yen, you do the same thing.
Mm-hmm.
U.S. dollar it's the only game in town.
Mm-hmm.
Gold will also do very well, but not quite convinced it's going to move at the same time as dollars.
Mm-hmm.
Lagging a little bit. But that will also be a great holding to have. We want to become quite aggressive to hold gold, but we don't hold any right now.
Mm-hmm.
We did hold quite a bit a few years back,
Mm-hmm.
and once it lost support, our last trade on gold was from 1680
Mm-hmm.
range. We haven't been back in since. But again, you just have to be patient and understand what your entry and exit points are.
Yeah, because a very interesting relationship that we that you can observe as well is with gold and or other precious metals such as silver and the US dollar have both been trending positively on an uptrend at the same time. Usually there's no correlation. They're in going in opposite directions, and that's what we've seen over the last little bit here.
Yeah, and that's what we'll see. So, holding gold in US dollars, not a Canadian hedge product, it's a pretty good opportunity to make a lot of money coming up. But again, if you think about it, but again, equities do quite well as well. Stocks, equities. And if you think about it, we're going to be in this extremely chaotic economy that you see recessions, earnings are declining, but yet the risky markets, what people think is risky, they are doing quite well. And the investments that people normally see as being conservative, are not doing well. That's the world that we're in. That's why it's chaos versus harmony.
Absolutely. Well, any last thoughts, I guess, before we round out the discussion?
I really enjoyed chatting to you today, and anyone who's listening, I encourage you just read our global outlooks. We literally have readers from around the world, and get in touch with us. We apply to everyone individually, so we can have a similar conversation if it's needed. Thank you today.
That's great. Well, Keith, thanks a lot for being on the segment today. If you want to get in touch with Keith, please visit icecapassetmanagement.com. We'll have the contact info here for you as well. You can also follow him on Twitter at IceCap Global, and you can subscribe to the Global Market Outlook. Pretty self-explanatory. You go to the website, you'll be able to view it right there. And you can follow IceCap's commentary going forward. Again, Keith, thanks a lot for being here, and look forward to the next our next discussion here.
Thank you, Sonny. Have a nice day.
Thank you, Keith.